Hello everyone and welcome to Momentum channel. My name is Mo, and in this video I'm going to be sharing with you the portfolio that my wife and I have built. It's currently sitting at close to $485,000. I'm going to be walking you through exactly what holdings we have, and at the end be sharing with you some of the key learnings that I've had investing in the stock market for the past 6 to 7 years more solidly, and what are some of the things that I would really recommend to investors who are just getting started, new investors, beginner investors, and I know there are many of those on YouTube and on Blossom. Let's get into it. All right, here's a quick look into our portfolio. You do see the different holdings that we have. We currently have 9 different holdings in our portfolio, all of which are exchange traded funds. They are listed here based on their overall performance. Our best performing holdings here are VTI and VFV. VTI is the Vanguard Total Stock Market Index ETF that gives us exposure to the entire US stock market. It's a hold in US dollar fund, and we hold it in our RSP account too, given that it has we can avoid the withholding taxes as a result of this USD fund holding in a registered retirement savings plan. Currently, it's up by close to 11.1%. Our next best performing holding here is VFE, another one covering the US stock market. Here, VFE is the Vanguard S&P 500 index ETF, focuses on the 500 of the largest US stock market companies, and it's up by as well 11.1%. Following that, we have shares of VT. This one is Vanguard Total World Index ETF, which is up by 8%. Through VT, which is available in US dollars, and we hold in our RSP account, we get exposure to the entire world stock market, with some exposure to the US, but mainly as well some exposure to the international markets. V equity is one which is considered to be an all-in-one ETF. With V equity, we get exposure to the US market, Canadian market, international markets, and emerging markets. It's definitely one of my favorite holdings. We currently hold our V equity in our Questrade account, which we have for our Smith Maneuver portfolio. To be honest with you, for many investors who are just starting out, if they want to simplify things, they could really consider only one holding, and it could be something like V equity, VEQT, or its kind of equivalent offered by BlackRock, which is X equity, XEQT. With those, by holding those, you are already getting the diversification that you would need, as well as getting exposure to the entire world stock market. So currently our shares of equity, as you notice, are up by 6.4%. Next big holding based on the market return sorted out here is XEC. Through XEC, we are getting exposure to the emerging markets, and it's currently up by 5.1%. Following that, we have shares of XEF. It's up by 4.4%. And through XEF, we get exposure to international markets. One of our newest addition to this portfolio is shares of QQC. With QQC, we are actually getting exposure to the NASDAQ 100. You do notice we currently have 420 shares of those. It's not necessarily the highest focus on dividend income, but more so for growth. It's focused on NASDAQ 100. Following that, we have another shares here in our holding. It's shares of VDY. VDY is in fact one of our largest holding. We currently have between my wife and I 2,846 shares of it. It is showing a total market value of $119,000 plus and an expected annual dividend income of over $5,000. VDY does pay a dividend income on a monthly basis, and I believe it's one of the holdings that has the highest dividend yield for us. Lastly, we have added some shares of ETF of cash, which, as the name suggests, it's one way for us to park some of our additional cash, and while collecting some interest, and really then repurposing and redeploying it at the right time that we see fit to buy more shares of one of our existing holdings that we have here. Aside from this cash that is in an ETF, we have some of the proceeds of our recent sales of our holding currently sitting just as a normal cash money in our brokerage account with Wealthsimple Trade. We've not repurposed and bought shares of cash, because the idea is maybe we are gonna buy those ones, use those funds to buy some of these shares sooner than later. I'm going to also walk you through the specific geographical exposure currently for this portfolio. The way that things are at based on the amounts of market values that we've invested, we are currently exposed to US market by about 51%. Our exposure to Canadian market is at 34% roughly. We have about 11% exposure to international markets and roughly about 4% exposure to emerging markets. When it comes to target asset allocation, for me personally, I would like to bring this exposure to the US market to around 60%. I would like to bring the exposure to Canadian markets down to about 15%. I would like to bring the exposure to international markets up to, I would say, around 25%. And lastly, the emerging markets hovering around that 5% or so. The reason for my exposure targets for Canadian market to be lowered and only about 15% is that, my wife and I, we both work in Canada. We have our primary residence as well in Canada. And pretty much majority of our exposure in terms of investments are to Canadian market. And given that Canadian stock market and Canadian economy is not, one of the largest in the world, it's only has a very smaller subset and portion of the overall world economy. We don't want to have overexposure to the Canadian market, hence wanting to lower that exposure over time. I have listed here for ease of reference the different management expense ratio. These are the fees, overall fees that we pay for holding these ETFs. These fees are deducted from the holdings itself directly. So you're not going to see these costs coming out of our accounts, and it's already being taken care of. The returns that we see are net of these fees for any of these holdings that are listed for our account that we have. The lowest management expense ratio, MER, belongs to VTI at only 0.03%, very, very minimal. And the highest is for the one for emerging markets at 0.27%. If I show you the different holdings listed by market value, our biggest kind of holding here belongs to VFE, the Vanguard S&P 500. We have close to $170,000 invested in it, or around 1,500 plus shares. The expected annual dividend income from VFE is at close to $1,900. You might be asking, how come we are collecting such an amount of dividend compared to VDY, even though we have a lot less invested in it and it has the highest amount of dividend? It's just the reason is that with VFE the focus is a lot more on growth, whereas with VDY it's really focused on around 45 to 50 Canadian dividend paying companies. And the focus is more so on dividend, not too much on the growth. Hence, you're expecting, as a result of that, higher amount of dividend income collected. And the rest of the holdings are also shown here for your reference, as you do notice. I'm not going to go through them one by one. And instead, what I would like to do, I would like to gradually bring to your attention some of the key learnings and some of the key consideration that I would like for beginner investors to take into account. By the way, if you're interested to look at this portfolio pretty much live and as the market gets updated, we have provided the link to this dashboard publicly and transparently on our YouTube channel, Momentum Finance. Be sure to check it out, and you will always have access to the latest and greatest of this portfolio. All right, some of the key learnings that I would like to share with you, especially if you're a new investor, I will want you to watch this and listen to this carefully. The first thing for me, I started investing more seriously about 6 or 7 years ago. And the key thing that I would say made me and my wife successful to get to the point that we are is trying to really focus on the things that we can control. We don't have any control on how the stock market is going to perform, how the economy is going to perform. Are we going to have a recession? Are we going to have like a year that suddenly the whole world is going to become upside down? We don't have any control over that. Instead, what we have control over is our own habits, our own savings rate, our own approach to handling money. As an example, as you earn income, as we earn income from our paycheck, the day job that we do, as well as in our side hustle, we make sure that we set aside a considerable amount of that towards our savings to build an emergency fund, but also put it aside and invest them, as you're seeing how our portfolio has grown over time drastically. That's something we have control over. We manage to put aside that money and invest it. The other thing that I would like to bring to your attention is don't try to blindly pursue dividend yield and a higher yield. You think that, oh, it's better because I just want to make sure I have that income coming into my account. I know it can be enticing, and especially if you're a new investor, that's something that you think would be very valuable, because you're probably thinking ahead. Like, wouldn't that be amazing if this dividend income can actually cover my cost, day-to-day cost, bill payments and whatnot. I get that. I get that the interest that you might have in it, and the desire towards that, but don't try to limit yourself just by dividend. What I mean by that is that there are so many amazing companies and stocks and ETFs out there that give you exposure to the broader market, not just the dividend paying companies. And if you limit yourself to only and only dividend paying companies, you're constraining your ability to take advantage of the entire successful companies that are out there. There's so many amazing businesses out there, many of which are considered to be highly growth-oriented businesses. You name many of those in the tech industries, like Amazon, Google, Meta, Facebook, Tesla. These are the companies that do not pay dividends. And in this case, if you just limit yourself to dividend paying companies through any stock picking or ETFs, you're going to miss out on those amazing growth opportunities. So my advice is, it's okay to have some exposure to dividend, but don't let that be your only decision making factor. If the underlying factors of the business is solid, they're paying a dividend, but they're also growing their dividend in the meantime, not just and not only just growing dividend, but also growing the business, there's more merit to wanting to invest in that business. Which brings me kind of to the third key point for you to consider. I would say if you're new to investing, exchange traded funds, ETFs, index funds are really phenomenal products. At a very, very negligible cost, they make the whole process of investing so much easier. Like I mentioned at the onset of the video, I've been investing in the market for a good 6 or 7 years more seriously. And even then, I consider myself to be somewhat familiar with the stock market, and perhaps okay, if I were to really do some research on stocks, I probably would be able to make my way through it. I think given some of my background and some of my interests, I probably could make my way through reading through financial reports and listening to earnings call and whatnot. But I don't have much of a time for that. I would say I'm like many of us, I would believe I'm quite busy with my day-to-day life, and I'd rather spend my time on more things that matter to me. And B, I would say especially this would be more important for new investors, is that if you start like really stock picking, you really have to dedicate the time to that. You have to dedicate the time to understand why you're kind of investing in a certain business, why you're going with this business versus some of its competitors. I think, yeah, it could be easy as flipping a coin and saying, oh, you know what, I use this business and I think I'm familiar with it. I think that's probably a good way of approaching it, but at the same time, not a thorough way of approaching it. I think it's good to try to invest in companies that you use or you're familiar with. I think that there's some reasoning to it. But at the end of the day, just because a business is something that you use and you have heard about and you're comfortable with, doesn't make them a long-term a good investment. There's other things that go into it. And I think for many beginner investors, that's something that you might not really have the knowledge or capacity or perhaps interest even to pursue, to spend hours upon hours to actually do that research. In those cases, I think, honestly, for my own sake and benefit, I think going through a low cost index funds is quite a great option for many investors. And when I talk about low cost, I think I'm comparing it to the benchmark and the grade of for example, a mutual fund. For mutual funds, the cost sometimes is around 2%, 3%. For many of these low cost index funds, their cost could hover around anywhere between that 0.03, as you saw even in my portfolio percentage, to sometimes around 0.30%. So 0.30. I think that range, or even maybe up to 0.40, I think that's a reasonable range. It's not that massive. It only becomes much more noticeable when you have a super large portfolio. But even for my portfolio, currently, given the entire holdings that I have based on the average, the weighted average of different holdings, my average MER is at 0.17%. And I personally, I'm very comfortable with that fee for the sake of simplicity and the buy it, set it and forget it type of approach that I have to my portfolio. I really don't have to worry about it, and I can easily pass the sleep at night test, even if the value of these holdings drop over time or go up and down, I'm not worried about that because I know I'm invested mostly in the broad market, reputable, low-cost index funds that I don't have to worry about it at all. And my wife and I have also built some cash reserve on top of everything else that you see here, just to make sure that we can take advantage of that. As much as we would love to repurpose and redeploy those funds to the market, and I understand the fact that we cannot truly time the market, but at the same time, we know that just looking at the fear and greed index as an example, we are at the time there, the stock market has gone up quickly. We are in that extreme greed kind of phase. And that's why we don't want to necessarily put a ton of new money into the market. We're okay with gradually buying some shares here and there, but we're just going to wait slowly and to see what's going to be happening over the next little while. Also there have been historically some months that the stock market has had some pullbacks, we wait for that. Hopefully, if that happens, and that's the opportunity for us to try to redeploy a lot more funds more aggressively and buy more shares of these same holdings that we have in our portfolio. I hope this video was beneficial to you and hopefully inspired you to as well get started with investing, saving, and wanting to pursue the goal of financial independence, financial freedom, because I think it's going to be super powerful and help you and your family and your loved ones to have more control over your finances, control over your life, and be able to live a fulfilled and rich life. With that, thank you so much for watching this video until the end. If you enjoyed this video and gained something of value from it, give this video a thumbs up and follow me on both Blossom as well as YouTube. I post videos weekly talking about the topics of investing, saving, and ways to reach financial freedom. Thank you, and I hope to see you all next time.